Stay away from treasury bills. If maybe right now, of course I'm making this video at around September of 2025. If you're thinking about, hey, you know what, money market fund are giving me quite low interest rate, so I should rush into the treasury bills, you know what, because if that is the idea that you're having so far, kindly just run away from that. Don't do it. And I'm here to explain. Some of you do not understand how these investments usually are intertwined and how they move. I have to clarify, this video is about how to stay or why you should stay away from the treasury bills. Okay, now, in case you're watching me for the first time, this is Good Joseph, and I make videos as far as the investments and money is concerned. And by the way, I upload a video each and every day, so you have all the reasons to go ahead and subscribe and leave a comment on the comment section. And in case you need my services, this is my number, and kindly don't call, just text me on WhatsApp. Let's get on the business now. Here we are. See, why am I saying you stay away from the treasury bills? Right now, as we speak, most of the capital markets are not, or should I say capital market is not doing good. Let me list some of the things you find in the capital market. 1 is T-bills, 2 is T-bonds, 3 is MMF, 4 is FIF, 5. Those are the examples, okay? Now, what happens, you find somebody, because a lot of Kenyans have invested in that money market fund. So you find that the money market fund right now is giving people below 10%. And if it's 10%, then it's around 10%. Now, you find somebody be like, okay, I think MMF is actually giving me quite low and whatever. Let me run into the treasury bills and invest there. Probably I'm going to get a little bit of higher returns. No, now you're shooting your foot because you're simply changing the forest, but the monkey is still the same. Let me explain. When you invest in a money market fund, meaning when you open a money market fund with the company A, are we together? That money, it is invested or reinvested in something called treasury bills, largely. The other two things they usually invest on, but largely that money is invested in treasury bills. So therefore, the rate in treasury bills determines the rates in money market fund. That's why the benchmark of the rates in money market fund is usually determined by the rates of the treasury bills. This is how it goes. If the rates in treasury bills goes down, are we together? Let's say it's around of 10%. We usually say plus 1%. Let's say the treasury bills around 9%. So you find MMF are playing around 10%. We together? Therefore, it's kind of a benchmark. So it's more or less the same. Whatever is being offered on T-bills is the same that is offered on money market fund. Why? For example, right now, for those who are investing in treasury bills, like I do, as much as I'm saying people should stay away from it, you find that the interest right now, okay, I did. So far, I'm not doing it, but I did. Now, you find like the interest rate is around, it depends with the period. Because we usually have 3 divisions of money, our treasury bills. We have 91 days, 182 days, and then we have 364 days. Or should I say 3 months, 6 months, and 1 year. You find it's like 8% on 91 days, like 9%-ish or 9 point something percent-ish. You are rarely getting 10% right now on treasury bills. The same case, that one is mirrored again on the money market fund. So when you are running away from money market fund to treasury bills, you're doing the same thing. You're subjecting your money into the same investment. You would rather run into the fixed investment fund. Let me explain why going into the treasury bill right now, it's not a good idea. It's not even a smart idea, by the way. Not because the treasury bills is bad or it's not safe. No, it is amazing. It is good. It is one of the safest areas to invest your money. When I say you run away or stay away from it as of now, based on the interest that you are getting right now, that is if you are coming from money market fund. But if you were just looking for areas to diversify, then it makes sense. I have to leave that big disclaimer because some of you don't even understand. You rush to judge. You just read the title and comment. You don't even listen. What I'm saying is this: if you are rushing into a treasury bill on the basis of diversification, not necessarily chasing quite a decent return, then you're good to go. Treasury bill is a good one. But then if you're coming from a money market fund towards the treasury bills in a search of better returns, You're not doing it the right thing, okay? You would rather go the treasury, you would rather even go a fixed investment fund way. Why? If you were to do anatomy of money market fund, they largely invest in three areas. One, T-bills. Two, CP, that is commercial paper. Three, FDS or fixed deposit or something like that, okay? But then if you do anatomy of FIF, they invest in these 3 years plus others likes of bonds and whatever. So they are likely, or they have higher chances of leveraging on higher returns. Why? One thing that you're supposed to know, there is a law or kind of law or regulations that any money that is invested in a money market fund, the asset manager by law, they are not supposed to reinvest that money in any asset that goes beyond 18 months. I don't know whether that will make sense. Okay, that's why you find in most cases money invested in a money market fund, it's hardly invested in treasury bonds because treasury bonds start from 2 years and above. So they are not allowed to take that money and invest there. Are we together? By law, that is, okay, or the book. Now, what happens is this. If you invest in a fixed investment fund, they have a chances of now, because the law is not does not bind this. They're not bounded. Is it bounded or bind or whatever? Okay, that name. They are not, let me use the bind, not bind. They are not bounded or bind or whatever to invest on only these three areas. They can be able to leverage on many areas. Therefore, there are higher chances of fetching more interest on this. Why? I'm getting a lot of DMs, people asking me, hey, Joseph, please tell us what to do now. The interests are not so pleasing. By the way, let me tell you one thing. This is the highest time now to keep on putting your money into an investment because this is now when the investors are built. When we can tell you are there. I remember back when in 2020, when the interest rate during the COVID-19, the interest rate were wanting, but we were just there holding on. So some of you got into these money market funds and bills and whatever when the treasury bonds we are having around 18% and MMF 16%. Now you're seeing 10%, you feel like you can. No, you just stay there. Relax. Markets usually goes like that. Like right now we are down, we are up, we are high, it just goes like that. It's like the stock market. Right now we are on a bull market. Everyone is like, hey, get the stock. A time will come, then you realize, nah, it's the opposite. Now the capital market now goes up. Again, it becomes opposite. Now goes. So this is how these things usually does what? Keep on exchanging, changing and changes and such kind of a thing. So as an investor, it's always good to know, hey, if this goes down, then I have to run towards this. But don't run on the same thing. It's like taking money from your. Okay, that's a weird example. Let me not use it. Okay. So now what happens is that if then that is your basis of argument, then please stay away from the treasury bills. But I have to single it out. Treasury bill is not a bad investment. It's a brilliant investment. It's a very good investment. It's a good area to keep your money, by the way. If you have some cash that you want to tie up to say for the next 1-ish years at most, then that is a place to be. It is one of the most secured investments, of course, with its sister or a brother treasury bond. By the way, this is what I would say. If then you have to go the government securities way, then you'd rather go the treasury bonds way. Because right now, as you speak, recently, in this month of September, we had a treasury bond that was going for around 13.2%. Was it that 13? Let's do 13% each there. But again, this one was going for quite a long time. 25 years, it was going for a quite long time. But it depends. So if you are looking for something that will give you a little bit of better returns, then you can go the treasury bonds way. But be informed, treasury bills and bonds are quite different, though they all mean the same, because this one goes for a higher or a longer period of time. So if you are looking forward into having some cash in an area or an investment where your money is subjected to a little bit of longer period of time in terms of an investment, then you can be able to go towards that area. If that's not the case, then please stay away from it, because you might actually get yourself into a problem. Just to recap exactly what I've said, there's nothing wrong with treasury bills. You can invest there later, but not for now if you're coming from the money market fund. But if you're coming from other areas, let's say probably you've invested in special funds, you have some money market fund somewhere, you have some other investment, you're just looking for an area where to diversify. Why? Because it is wise to diversify. We always say that we don't put our eggs in one basket. Diversify so that you never know when the disaster will strike. Then if that is the argument, then you can just go ahead and put that money into. Or You may have a different arrangement. You can be like, you know what, I'm looking for an investment. I have Y amount of money, and say I want to start a business, say at the beginning of next year, January there, or February. I'm making this video around September. You can be like, okay, I don't want to access this money because I know my character. I'm not so good when it comes to discipline, but I'm looking forward where I can put this money in the next, say, 3 months or 3 months-ish there. Then you can open a treasury bill and put your money there, because it will be quote unquote tied down for the next 3 months. And once that period lapses, then you can get cash and your money back, and you can go ahead and do your investment or your business or whatever you want. If then that is the argument, then it is good. I only discourage you if your argument was to run away from MMF towards the treasury bill, thinking or expecting, or should I say hoping, of which you shouldn't. I should say, if the things are verifiable, don't hope. You actually do what? Get into yourself into that particular thing. Anyway, that is good, Joseph. And in case you need my services in one way or the other, again, just like I said at the beginning, that is my number. You can shoot me a call on the comment, or rather on my WhatsApp. I'm going to leave something on you on this particular video. If you have any area that I've talked about, or you would like me to talk about that I have not talked about, I've noted it down. Some of you want me to talk about cryptocurrency. Some of you want me to talk about some other areas of investment, like the balance fund, the bond fund, the equity fund. I'm going to try the best I can. I do that. So I'm noting down all the comments, all the questions, all the inquiries that you guys might have. So on the comment section on this video, please tell me, what area would you like me to clarify so that you can be able to understand. And yeah, just stay put, guys. Something is cooking. I will tell you what is it as time goes by. This is Good Joseph. See you.